supplement. Today's the 29th of September 2024, and this week's is called Opportunity Knocks. Requires a bit of out-of-the-box thinking, bit of contrarian thinking and all the rest of it, but suffice to say, I always like to start with a quote, and this week's is: be fearful when others are greedy, and be greedy only when others are fearful. And that's Warren Buffett, legendary investor, but that's with my emphasis on the only, which I'll talk a little bit about later. Just one more plug for the Property Business Workshop. It's on Tuesday next week. I know if you haven't bought your tickets yet, you're probably not coming, but one more shout out, because exit is the theme of the season, to be honest, either for other people and therefore your entry points are their exits, or planning your own. And I know some people have brought forward some exit plans with the spectre of the budget on the 30th of October in mind. I've got my own thoughts about that, which I'm going to go into today and hopefully share with you and give you some insight into what I'm thinking. The tickets are still available though at the URL bit.ly/PBWFOUR. And then next week, don't worry, I'll be talking about the next workshop, I'm sure, that we've already got planned for 2025. But welcome. It's been quite a week at my end. I'm actually nicking a couple of extra days from last week because there wasn't time to talk about everything I wanted to talk about last week. But it's been a real roller coaster. I did say last week I was going to try and make it to Liverpool on Monday for the Labour Party conference. I made it to the fringe events. I didn't go into the actual conference itself because most of the housing stuff was actually in the fringe events anyway. So I was comfortable with doing that. I've got some thoughts on that. I've also got some thoughts on a portfolio I viewed last Friday, which is a really stark reminder of why so many people dislike landlords, apart from anything else. But I've also got some economic observations from that, which may not be that popular, but then economics is rarely popular. It's definitely an interesting conversation though. And then Thursday this week was the best day for procurement, not necessarily in terms of quantity of units, but in terms of number of deals and in terms of just overall opportunity for probably 4 years ago or so, I would say. So probably the best opportunity since before the pandemic, apart from bigger portfolio deals. But I'm talking about quantum, number of opportunities out there, almost too many for us to keep up with. So that's interesting and I think worth talking about as well. So that's all about the deep dive. But before we get on with the deep dive, you'll know I like to start with the real-time market info and then go into the macro. So weekly love, big love to Chris Watkin. He delivers week in, week out on these. And I love and I share his genuine excitement when he unveils a new stat or an unreported trend or busts the myths of what's going on in the broader press and media. So listings are still cracking on, down a little bit after the beginning of September rush, but still 37,500 across the UK in the week in question. Big numbers. 7.7% higher than pre-pandemic listing numbers this year to date. So plenty of stock still out there, folks. Net sales outperforming, 32% higher than the equivalent week in 2023. And we're 16% above net sales for this point in the market for last year. And you'd expect this final quarter of the year as we go into it to be better than it was in 2023, where we were really still suffering with very high rates until we really started dropping like a stone in sort of November, December. But by then it's too late really to stimulate the housing market because everyone's put their out of office on apart from anything else and people aren't looking to move and buy. So mid-September, sales agreed figures now see the sold subject to contracts above the year's high in July when it comes to pricing. So it looks like a pretty typical August lull really. Direction of travel is upwards. It's nice and slowly upwards. I think everyone would prefer slowly upwards, sustainable, in line with wage increases, things like that. I'm still not changing my 5% prediction for this year in terms of the pricing in the housing market in the UK. It's a bit late to be changing 2024 forecasts anyway, let's face it, although it hasn't put off some of the other economic forecasters this year or in the last couple of months, and they still seem to be getting it wrong, which I find mind-blowing, but there we go. Listing prices stay higher, the tailing off of the annual phenomenon. Central London homes going back to market when the back-to-school thing happens still seem to have a bit of a lagging effect throughout the whole of September. Price reductions, 1 in every 6.5 properties per month, so pretty chunky, 100,000 reductions per month on Rightmove, worth knowing and thinking about. And look, ultimately, houses are selling, but they must be fairly priced, and they need something to make them stand out if you're trying to achieve anything like top money, basically. So we're about 55,000 gross sales below where we were at this point in the year in 2022. Now, if you think back to 2022 and what happened here on in, there might be a chance of actually catching 2022 as a whole by the time we get to the end of the year, because there were a huge amount of fall throughs in late 2022, but there were a very low amount of fall throughs in early 22 when the market was booming. We'll see where we end up, but when the dust settles, I wouldn't be surprised if we actually saw transaction numbers fairly similar to what we saw in 2022 in the end. Although some of that 2022 late pain obviously kicked through into 2023's figures because it takes months to transact. And a lot of people who had sales agreed, if they were smart, when Liz Truss came in and the mortgage rates went up and up and up, they had existing mortgage offers that they wanted to complete on at the older, lower rates apart from anything else, and so they preserved them and those deals still went through. So we'll see, but I think it'll look like a relatively healthy year in terms of transaction numbers, and we'll find out. So macro news this week was a lot quieter, but it means I can bring in Friday's retail sales from the week before, which got squeezed out last week because it was so busy. We've also had the flash PMIs for September, and anyone who listens regularly will know how much I love those because they give us some good real-time insight. And then we've had some figures from the CBI, industrial trends, distributive trades, with mixed messages, to be honest. And then we always have our last piece of the puzzle, which is the gilt and swaps markets. So retail sales, well, it was a pleasant surprise for August, well above consensus print in a market that really has struggled through cost of living and also from just the weaning off from the pandemic and the over enthusiasm there was in consumption, when people realised they could do real life things again instead of just buying stuff on Amazon to numb the pain of being locked indoors, of course. So all the figures when it came to retail sales were well ahead of consensus. Month on month 1% rise, expectation was 0.4%, 1.1% ex fuel, compared to 0.5% expectation, and 2.5% year on year instead of the expected 1.4. So if you adjusted that for CPI, that's actually a real terms increase for the first time in some time, mostly because any other rises haven't been up to where inflation has been in the last few years. But is this the end of the retailers' woes? Well, I find that unlikely, really. There's still a hefty minimum wage rise slated for next year already. The oil price, which you might have noticed has led to drops at the pumps and the cheapest prices for some time. Still plenty expensive enough, I'm sure you'll say, but once adjusted for inflation, fuel looks relatively affordable for the first time in years. And that's going to help with the figures overall next month, I think. One of the major contributors to the price movements is Saudi, because they're saying they're going to pump more oil. Aside from anything else, they need more money for this incredibly ambitious NEOM project, which they're involved in. If you haven't listened or watched or read anything about that, it looks like something from a science fiction novel, so I'd recommend you go and have a look at it. Retail sales volumes are still about 6% below where they were 3 years ago, but they're about where they were in 2022 at the moment, only 0.4% less when it comes to volume. Obviously, prices paid are a bit higher, but volumes really tells us the story of the sector. The performance, it was, according to the ONS, unseasonably strong for August, particularly for food and clothing sales. But of course, that'll be welcomed. We never get carried away with 1 month's reporting, but 3-month growth did look good, and prices have started to become competitive again. Following pay increases as well, there's some positive impact, but we need more of the same, of course. So, the PMIs, just a little reminder, they're an index. They're based around the number 50 as the benchmark for growth, which is above 50, or contraction, which is below 50. Much more real time than waiting months for the ONS to deliver their lagging growth figures. And they're also valuable because they get real time commentary from large businesses and people in the know. So what we started to see and hear in confidence surveys earlier this month was wobbles based on doom and gloom and the approach of the new government to the massive task that they face. I think the attitude of business, as I've heard it, has been the same, really. Yes, we heard you. That's why the country voted the last administration out. Now, get on with it, rather than telling us all how hard it is. We've got to get on with our businesses. You get on with your business of running the country. And the recognition of that message, having got too bearish, especially from Kier Starmer, really played out in the way the conference speeches were crafted this week. I'm not going to spend a lot of time talking about them this week. I may look next week if there's been more of a reaction to them, but I don't think there's been much in terms of reaction really. Rachel Reeves did a better job than Keir Starmer of deflecting and refocusing and being positive, I think, but have they really landed, and will they have been enough? The initial confidence damage has been done, the budget's only a month away, and it's really easy now to defer decisions for one more month in a large business, and that's inevitably what will still happen now, in my view. Anyway, the PMIs. Flash estimates, updated then in the first week of the following month, but these are the proper September real-time estimates. The spoiler, all of them were below consensus expectations, which was exactly what I expected, because of this bearish news and the bearish chat we've been experiencing. But they weren't disastrously below. So composite flash output 52.9, still pretty healthy. If we're at about 53, we're congruent with an economy growing between 1 and 1.5% a year is the general rule. August was 53.8. Services defines the economy really, 52.8, down from 53.7 in August. Manufacturing, which had been improving, back to 51.5 from 52.5, but you'll see still expansionary territory. So as I say, consistent with sort of 0.3% or so of growth per quarter. Good news overall. We've vastly outperformed that in the first 2 quarters of this year, but a flat July makes it less likely that we'll outperform in Q3. There's still hope, but 0.2 looks and feels a bit more likely from what we've seen, even if August does 0.2 on its own. We'll find out in a few months' time, of course. So the positives, well, it's 11 months in expansionary territory, which is most welcomed. Prices charged inflation eases to a 42-month low, which is welcome for rate setters and consumers alike. And there's still a hat tip to wages being higher and shipping costs being higher too. Some of the messages are also fairly standard. Stronger exports to the US, weaker sales in the EU, employment growth slowing but still growing, marginal increase in services, job cuts in manufacturing. Backlogs of work decreasing for the 17th month in a row. The summary from the chief business economist at S&P, Chris Williamson, is always solid. He cites encouraging news overall. He still mentions a soft landing rather than no landing, which would be preferable for the economy. He's at 0.3% GDP growth for Q3, which is what the historical figures would tell him. But he also cites the budget, just as many firms did, because by far the most cited concern was fiscal policy uncertainty. Investment plans and hiring has been stifled. Chris Williamson has also been very good in his commentary about rate setting, and I must admit he's one of the few people that actually influences me, because as a rule I try to think for myself, but he finishes the report this month by citing the lowest services inflation since February 2021, bringing the 2% inflation target closer to view, and suggests there is scope to cut rates in the final months of 2024. Now, we've had this oil price drop that I referred to earlier, and the overall slight slowing of the economy, even if I think it is mostly for fear reasons. I think this has dramatically improved the odds of a cut. Although at one point, supposedly the economists were 100% certain there'd be a cut in November, which is always ridiculous to be 100% certain over anything that hasn't happened yet, let's face it. But any one of those who've bet at really short odds on a cut for November look like they might well get away with it. Or let me put it another way, a big upside miss for inflation next month looks unlikely, and that'll be the last inflation figure before the bank meeting. My initial read was for cuts on a quarterly basis being desirable by the Bank of England. It makes them look calm and in control, which isn't just about their reputation management. It also looks good for the international reputation of the UK. And in spite of the 8-1 vote last time out, which I referred to last week, it's probably time to pin the most likely outcome at the next meeting as things stand on 5-4 or 6-3 to cut. It could be more comprehensive than that, but I don't think Catherine Mann or Megan Green are voting to cut just yet, to be honest. The meeting's also a week after the budget, which doesn't give much time to react to what might or might not be needed there, but it does seem Rachel Reeves is working a lot more closely with the OBR and the Treasury than certain Chancellors of the Exchequer we've had in the past few years. Not Jeremy Hunt, he was very good at that part of the job. But still, expect October to be packed with fear around negative labour rule changes for workers from the company's perspective, further hiring freezes and the likes. Anything that looks like an economic slowdown at this fragile time will put a bit more pressure on the Bank of England, who do have responsibility in the jobs market, for example, although it's secondary to their inflation targeting. But they are supposed to look after unemployment, apart from anything else, as a secondary objective, in the way that they can by only controlling monetary policy, of course. So I've said this about the quarterly meetings for some time, but the most important part of November's meeting is the inflation prediction in 3 months' time. And if that number's 1.5% or below, that massively strengthens the case for cutting rates. Last time out, it was 1.5%, and then they cut, of course. And there are also real reasons to believe it might be at or below that 1.5%. The bank is pretty bearish on economic performance in 2025 as we're slowly continuing to absorb COVID shocks. The structural inflation argument has waned a bit since the last meeting cycle, I think, although sterling still looks very strong compared to the big rivals, who have a lot more certainty, it seems, at this time in terms of their cutting cycles. I'm not 100%, and I wouldn't be, but I'm getting closer to the 90% camp for a cut than the sort of 75 to 80% camp I've spent some time in over recent weeks. It's harder to find reasons not to cut unless you're particularly hawkish. I see November and then December as cuts being really unlikely, but like I say, you've got to consider the budget, and there's time left to go. We've still got 3 months of the year left ultimately, and the last meeting of the year is in the week running up to Christmas. So before I move on from the PMIs, having got somewhere on the resultant path of the base rate there, I think I want to touch on the UK report on jobs. Now, this is produced monthly for KPMG and REC, the Recruitment and Employment Confederation. S&P produce it as well, just like they do the PMIs. And it points to permanent placements falling in August at a greater pace than before, lower demand for temps and reduced demand for new staff at companies overall. Salaries rising but at a slower pace than even the historical trend, and the lowest pace since March. So all quite a lot better signs for inflation apart from anything else. Now, things are well below the 50-point benchmark for permanent placements, and they're about the 50-point mark for temps as well. There was strong growth in staff availability, but mostly for temp placements. And both of the commentators, the chief execs of KPMG and REC, put together a much stronger case for rate cutting as well, in a clear message, because obviously they have a little bit of influence on the MPC and the Bank of England in general. So, CBI numbers, distributive trades, first of all. Headline was around marginal growth in September for retailers after 3 months of downturns. The +4 print was very welcomed compared to expectations of -19. That looks in line with the sales figures for August, and October expectations are for similar growth. Weather's bound to be wheeled out again when we get September's figures though. Look at the flash floods that we've had, for which I want to take a brief segue. Let me say to you, rainfall and the volume of it is not being factored in correctly by many people in property and business purchases. This much I'm in no doubt about. Let's recap and be sensible. We need to follow data and trends, not be caught up in any maelstroms. Indeed, making this about climate change, man-made or otherwise, is not sensible. Instead, let's just have a quick look at the stats. March 2024, headline in the FT referring to the wettest 18 months in England since records began in 1836. And you'll have noticed it hasn't exactly been dry since March. 2012 was the wettest year ever for England, 12 years back. The wettest day recorded in Britain was 5th of December 2015, 340 millimetres plus of rainfall in one day in Cumbria, in Hollister Pass. 2011 to 2020 was 9% wetter than 1961 to 1990. And probably the most damning one, 6 of the 10 wettest years ever across the UK have occurred since 1998. And you see a similar pattern if you look at the hottest days, weeks, months, the highest temperatures on the planet since records began. Surface water, though, for rainfall is particularly bad. You'll have observed that yourselves anyway, but also according to the Met Office, who state that both frequency and severity of surface water flooding will continue, particularly in urban areas. So, let me say very clearly, flood risk, and particularly surface water flooding risk, should form a large part of what informs you with respect to divesting existing stock and also buying new stock. That's the end of the segue. So, the CBI's other important output this week, which is Industrial Trends Survey, told a miserable story for manufacturers. Output dropped sharply in the 3 months of September, expectations of another drop in the final quarter of this year. The first negative expectation since November last year as it goes. So the lead economist talked about the fragility of 2024's manufacturing resurgence and, surprise, surprise, cited budget caution. I thought there was a very sensible quote, so I've repeated it here. In the meantime, firms will be looking to the Chancellor to reaffirm the government's mission of long-term economic growth, providing them with the confidence and opportunities to invest and grow. And a lot of what I was saying into what felt like a void, to be honest, at some points for various reasons. Jeremy Hunt didn't do a bad job at all. He played the game with skill. The way to be better than Jeremy Hunt is to change the rules of the game, because the rules are nonsensical at points. Sunak, we know, was a more than capable Chancellor, even if he missed a big old opportunity to fix some mega cheap debt for 50 or 100 years when he could have done that in 2021. There's a lot of calls from Ben Jones, the CBI lead economist, around delivering on what's been promised, which is an industrial strategy. We need to see some of this, or get some sneak peeks, sooner rather than later, in order to bolster fragile and waning business confidence. Simple as that. Do what you say you were going to do. Rule one of life, let alone business and politics. Okay, wrapping up with the gilts then. This week didn't move the needle much at all, and the drift that started last week and was bolstered by strong sterling, as well as others looking more nailed on to cut rates than we do, certainly in the short term, just meant a boring and miserable week where we opened at 3.727 on the 5-year and closed at 3.824, so 10 basis points the wrong way. Now, Thursday's close was 3.859, but the much larger discount continued in the swap markets, with the final Thursday swap being traded at 3.585. I'm struggling to explain this sudden 25 basis point discount for the swaps apart from in supply and demand terms, aside from a hat tip to the fact that sterling appears as desirable as it has done for many a long month, I would think. If any investment bankers out there or bond traders want to set me straight or enlighten me further, I'd appreciate it, and of course I'll share that with anyone else if you want to message me on LinkedIn or on here. That'd be great. 5.6-ish% then we should be looking at for mortgages, limited company, no fees. We're looking at close to 5.8 still at the moment, so swap rate plus 2%. That would be good to see. I suspect the lenders will remain quite cautious, as this is quite a new development in terms of the drift between the swaps and the gilts, and they're more likely to wait and see, although a few are still making headlines by cutting rates. Now that's as upbeat as I can be in a week where the yields move against the borrowers. So, onto the deep dive. Firstly, a throwback to this week's quote, because the great man is often misquoted in this situation. If you don't include the only part that I emphasised, be greedy only when others are fearful, then the whole quote changes direction. I think it often gets misinterpreted about greed, but as with everything Warren does say, it is quite carefully considered. So, initially it's caution first approach. When everyone thinks it's easy, it isn't. The trend is your friend, but not at the end, the traders say. It's also not to be interpreted as being a contrarian for the sake of it, but as a reminder you need to think independently and be different in order to get different results. So on Thursday, we as a group agreed terms on 9 units in 7 separate transactions, all under auction terms, although some were post-auction or even outside of auction conditions and just 28-day completion promises. This sort of day has not occurred in my group since 2019. Now the good thing is, I also had suspected it was coming. Pricing was spot on. One of the units was at a 20% yield in the Midlands, no less. So, why? Well, you try and find the reasons for landlords to be positive at the moment. Now, I can do it for you. Rising rents makes sense as long as there's affordability in the areas you're investing in. No point if you've already hit the affordability ceiling. Capital growth highly likely, slow and steady, most likely, but wages are chugging along, credit is getting cheaper from where it was a year ago or a few months ago. It's relative, but new buyers are getting mortgages around the 4 to 4.25% level, and the best buys are even cheaper, an affordable rate in a normalised world. Also, if we go one level down, so many people want out. They couldn't wait to complete before October the 30th and the budget. It reminds me very much of the post-referendum. The sky was falling according to some, and they reacted by selling at a discount to get out. That wasn't smart in general. And just had a comment there from Paul. Hello Paul, good morning. And he says lots of stock being dumped in September because of the fear of CGT. Completely agree. So, tune into the rhetoric though. The Renters' Rights Bill, the end of the AST era, the biggest changes since the Housing Act 1988. True. But yet no mention of rent controls yet in any real way, shape or form. They're coming, I hear you say. Then you need to adopt the institutional mindset to them and know that that means a rent increase every year of a somewhat guaranteed amount and factor that into your figures. The budget will ruin all our tax planning ever and take all our money. Okay, I haven't heard anyone actually say it that way, but what I do seem to be hearing from some vendors is something like that, and I simply refer you to the weekly mantra, keep calm and carry on. You'd think CGT was already at 40 or 45% on property the way people are talking. I think we know with some certainty we are seeing pension reform, but look at the fact that Rachel Rees is reconsidering the non-dom tax changes, listening to or playing the game with the OBR. I've said this for some time. If the OBR doesn't like the tax changes and says that changes will put GDP up, then that's something they would do If it's going to not put GDP up or not put the tax take up, right, then they're not going to do it necessarily, because it just adds to the black hole the other way. So we do need to consider that. So, hands up about this week. I was greedy. I was greedy only when others were fearful. I'm sleeping pretty well on the back of that. These opportunities, like this one right now in the run-up to the budget, don't come along that often. There were two of them in 2016. The 3% stamp duty market and what happened immediately after, which is where the opportunity was, as all the lemmings rushed to complete before the 31st of March, and then post-referendum. Well, in that one, I went to South Wales and bought aggressively, stitching together a few opportunities simultaneously. It's quite easy to go a year or more without one of these opportunities. I see this as a golden time. If you're staying in the game, you're going to ride the lightning with more regulation, but a stronger business case and more demand than ever. That's the decision you've got to make. We still feel exactly as we did after George's budget of 2015 as a group. The message is clear. Go big or go home. Okay, in a roundabout way, that brings me to the Labour Party conference. I've said that this iteration of the Labour Party, in spite of some serious scaremongering in some quarters, really aren't very different to Cameron and Osborne. We've mostly forgotten them because of all the events since they were the number 1 and 2 in power. Somewhat satisfying to refer to George Osborne as a number 2. I wonder why. But look, they loved big business. They adored it. You can see why perhaps 50% of business investment in the UK is done by the largest 0.5% of companies. We need that investment to have a functioning economy. However, it all looked and looks a bit cosy for me, for lobbying. There needs to be a more arm's length approach in dealing with the most monstrous, powerful organisations, big tech, big food and the likes. If I was anywhere near the government, I'd look at repurposing the nudge unit to nudge people economically with taxes, including the behaviour of firms. The mental health fallout of social media and smartphones, particularly on teenage girls, extremely well documented these days, would be paid for and taxes raised to fund proper mental health support, for example, or encourage the firms to be more proactive in how they control obsessive usage, content control and the likes, rather than just allowing them to be uncontrollable, unaccountable, fake dopamine factories ran over. But that's just one example. So, back to the chief point. Starmer and Reeves, in my view, are just as in love with big business as the solution. No more so than in housing. What's the biggest announcement we've had so far in this parliament? Well, I'd suggest it's the Homes England, Lloyds, Barratt, Maid partnership. 1,000 plus home developments all the way up to 10,000 plus homes and new towns on the slate over 10 to 20 years or more. What do they want then from their landlords? They want build to rent. What's the problem with build to rent? Well, there are a few, but particularly high rents and a need therefore to create homes for the demographic that can afford it and will pay. A little bit like leased cars, premium prices for shiny new things at the start. So the tendency is to focus on London, although the Northwest also has a fair chunk. The rest of the country is much more sparse. The tendency is also to focus on those earning at or above the median income, young professionals in better paying jobs. And that's not the reality of the PRS as it goes. You can't replace the PRS with a combination of social housing, certainly not under the current framework, because there's a huge swathe of people who earn too much to be in social housing, who still want, need or choose to rent. Remember the stats: average social household earning 25k household income, average PRS household 34k, average owner-occupier household 59k. Right? These are the figures that the Bank of England is working from, or was in a report a few months ago. So you can see where the gap is there very, very easily. So what are the other problems? Well, older stock. The first event I attended at the conference on Monday included Peabody, one of the UK's oldest not-for-profit housing associations. They have an average rent of £137 per week, despite significant presence in London, and spend 80% of their rent roll on maintenance and management. Let that sink in. There's little room for financing there, although they do have 40% gearing to the cost of assets, which I suspect is well below 20% loan to value. It can work if you've built homes at the old prices, but what's the business case at £2,500 a metre or more? They still have 5,800 homes under construction and completed 1,381, 1,204 of which were affordable during the last reporting year. 371 million was spent looking after residents' homes of their 108,823 homes. They also have a nearly 80% EPC C+ rating, 78.6 as it goes. They've got grants, subsidies and joint ventures. They subsidise rents to their levels below the market rent by £721 million per year last year. Mind-blowing and incredible when you look at it. increased the portfolio by 1.29% in unit numbers. That would assume no disposals, which isn't right, but it isn't numbered in the reports, the number of disposals. Net grants for the year were up 197 million on the year before, which doesn't translate directly to the number of units were delivered, but is £142,000 per new unit added in that year, which gives you some idea of how they can afford to build them, right? Just under 1.6 billion already committed to these new units and further development. 133 million is cash available, so about 8% of their capital commitments is actually cash. The rest, 92%, from debt funding and grants. This bit I just find it a little bit hard to get my head around, as I can't imagine positive cash contributions given the price of debt today, even if they're paying 0.5% above the gilt yields. But there's about 5.6 billion of equity, according to their balance sheet, which improved by about 50 million in the past year. Their revaluation reserve is 926 million. And remember, that's the increase in the value of their assets compared to the cost price of the assets, which is down from 1.112 billion the year before. So, as you can tell, I've never assessed the financial position of a housing association before, and I found it quite fascinating. They've got some long-term bonds outstanding, 2034, 2043, 2048 and 2053, looking like a long time out before they suffered too much from the change in the interest rates, but of course relevant for any new debt they acquire to undertake new projects. Their overall debt maturity is 3% of it maturing in the next year, 5.5% in the next 1 to 2 years, and 23% of it maturing between 2 and 5 years, with the rest maturing at an over 5-year point as per the longer bonds above. Looks like their CFO also predicted the changes in the interest rates in 2022 quite well. So have that level of balance, and nothing is going to rock the boat too quickly. 30% of their debt interest is on floating rates though. I can't imagine the level of demand for rents at £137 a week on average anywhere near London, since you can barely get a property anywhere in the UK for that sort of money on the private market at this time. If you search on Rightmove for rents in London, 39,155 results, including let agreed. There are 7 which remain if you cap at £600 per month and look at 1 bed's minimum. That removes the parking spaces and the garages. And of course, those are primarily HMO rooms, but they're at the very cheapest level. Anyway, fascination aside, these are the organisations the government is looking to plug the gap. The new units wouldn't be at £137 a week, of course, but they're also not suddenly going to be at £250 a week either. The grant money is significant, particularly when considered per unit, and ultimately explains a fair bit. This is the model they want to use, and they're willing at this time to be extremely discriminatory in favour of the larger institutions in order to spearhead delivery of the new units as they see them. You can't see that any more clearly than with the current Renters' Rights Bill and the student accommodation sector. Landlords with student HMOs have got some really stark choices. Much higher rents, much more risk, different tenant types, versus PBSA, who are going to get 12-month fixed-term models, not changing their risk type much, if at all. So what I struggle to understand is how they can't understand this oncoming transition period. Right, we've seen 9 years since the 2015 budget. We've seen much less change than expected. We've got a huge gap between who can rent and who can own. So I also wanted to pass comments on the MPs that I heard speak at the various panels. I was moved and impressed. Interesting backstories, including childhoods growing up in temporary accommodation, being evicted, being on waiting lists. And this wasn't chips on the shoulder stuff. This was genuine life experience. Now, the unspoken part really was about cash injections that are going to be needed. The planning system is one thing, but look at all the money that's going to be needed for retrofitting, planning, grants, local authority builds, and all the rest of it. There are ways to make the maths work, but I'm not hearing about these ways being parts of the solution as yet. It was educational, it was informative. I must say I quite enjoyed it one way or another. I did feel quite grim when I saw how many people are still out there expecting the government to sort things out for them, when realistically we all know the only person who can really do anything about stuff is ourselves as a general rule. I then talk a bit about a portfolio that I went to go and view. I'd encourage you to go and have a look at the supplement there to see what I talked about, but generally speaking, vastly below market rents, no inspections, agent really copping a deafen to most things, but really the brutal reality, tenants choosing to live in much cheaper conditions rather than rocking the boat because they know it would either lead to potentially prohibition orders or things like that, or landlords being forced to fix stuff but putting the rents up in order to compensate. So a really tragic, difficult economic balance that we're talking about there. And then I talk a bit about the adjustment of the market in terms of mortgages and rents rocketing up since late 2022. So 18% increases in the last 18 months or so in about a dozen parts, and then it trickles down accordingly, but massive issues, and then no real solution to the EPCs, which we need to hear guidance very quickly from the government. So I'd encourage you, if you've got time, to go and take a look at the supplement on the Partners in Property website or on my LinkedIn. That's all for this week. Still chances to buy very last minute tickets for the Property Business Workshop at bit.ly/PBW4. So as I always say, there's only one way you can deal with all this ongoing noise and excitement, because I think we've got the opportunity of the next 5 years ahead of us in the next 4 to 6 weeks or so. Keep calm, always listen to the supplement, and carry on. Thank you.